All right, we're diving back into cat bonds.
Feels good.
And I know you've been following along with Vijay Mangnani.
Absolutely.
He's been doing some really fascinating work on LinkedIn,
Yeah, his stuff's great.
especially Riding the Wave. That was a really interesting piece.
For sure.
But today we're zeroing in on his latest,
Okay.
Beyond Returns, Quality Trends, Defining Cat Bonds in 2024.
Interesting.
We're not just looking at returns anymore. We're getting picky,
Yeah.
trying to figure out what really makes a cat bond high quality these days.
Especially in this market.
Exactly. It's a crazy market out there.
It really is. And the definition of high quality has changed so much.
It really has, even in the last few years.
Yeah.
What investors are looking for,
Yeah.
what sponsors are offering.
Right.
It's all changing so fast.
It is. It's a really dynamic space.
It is. So Vijay, he breaks down 4 key indicators of cat bond quality.
Okay.
You ready to unpack those?
Yeah, let's do it.
All right, so first up is the expected loss profile. So that basically tells us how likely is it that this bond is going to take a hit from a catastrophe.
Right. So the lower the expected loss,
Yeah.
the less risky the bond.
Makes sense.
And Beyond Returns highlights a really big trend here.
Okay.
Back in 2021, 2022,
Yeah.
only about 65% of new cat bonds had an expected loss under 3%. But in 2024, that number jumped to almost 80%.
Wow. That's a huge shift.
It is. It's a big move towards less risky bonds.
So is that investors being more cautious?
Maybe.
Or are sponsors just structuring the bonds differently these days?
I think it's probably a little bit of both.
Yeah.
Investors are definitely looking for more stability after all the volatility we've seen.
Right.
But sponsors are also realizing they can attract more investors by offering these lower expected losses.
Yeah, so it's a win-win.
Exactly.
All right, next up, we've got peril distribution.
Okay.
So this is about what kind of disasters are covered.
Right. Exactly.
So are we talking hurricanes, earthquakes, fires?
All of the above.
All that stuff. And we're seeing some interesting shifts there, too.
We are.
Like a few years ago, it was all about these multi-peril bonds.
Right.
You know, coverage for everything all in one package.
Yeah, one-stop shop.
But according to Beyond Returns,
Yeah.
those are becoming less common.
Way less common.
It's like everybody's just focused on Atlantic hurricanes right now.
It seems that way.
Over 70% of new issuances in 2024 were hurricane bonds.
That's a lot.
It's wild.
Yeah.
But is that level of concentration a good thing?
Well, it's kind of a double-edged sword.
Okay.
On the one hand, investors can really target their exposure.
Yeah.
But on the other hand, it creates a lot of systemic risk.
Right, because if we have a major hurricane season,
A lot of those bonds are going to get triggered.
all at the same time.
Exactly.
And Beyond Returns pointed out another layer to that, too.
Okay.
Even within Atlantic hurricane bonds, there's this shift away from covering the whole U.S.
Right.
to focusing more specifically on the Gulf and Florida.
Yeah, they're really honing in on those vulnerable areas.
Yeah, and it makes you wonder, especially with climate change and everything, if
Yeah.
that's going to make hurricanes even worse.
It's definitely something to watch.
Okay, so we've got expected loss, we've got peril distribution.
Right.
What's the third indicator of cat bond quality?
Trigger type.
Okay, and this is where it gets a little technical.
Yeah.
But stick with me, folks.
I'll try to keep it simple.
So essentially, the trigger type defines what has to happen for the bond to actually pay out.
Right, exactly.
And Beyond Returns explains there are 2 main types.
Okay.
Occurrence and aggregate.
Okay.
Occurrence is pretty straightforward.
One big event.
Yeah, like a hurricane hits a certain wind speed.
Boom. Payout.
Exactly.
Those are usually seen as less risky.
Yeah.
Easier to model.
And investors tend to like that.
They do.
Aggregate triggers are a little trickier.
Yeah, they're based on the cumulative impact of smaller events.
So like a bunch of smaller things happening over time. Those are harder to predict, right?
A lot harder.
More variables, more complicated.
For sure.
And for a while, it seemed like occurrence triggers were becoming the dominant type.
They were, but then 2024 happened.
What happened?
Aggregate triggers started making a comeback.
Really?
Yeah, which I thought was really interesting.
That is surprising.
Yeah, I wonder if it's because sponsors are pushing for more aggregate coverage.
Maybe to protect themselves from more things.
Exactly. Or maybe investors are just getting more comfortable with it.
Maybe they're getting more sophisticated.
Yeah, that's possible.
It's a good question.
It is.
And Beyond Returns doesn't really give us a clear answer.
No, but it definitely highlights how this market is constantly evolving.
Yeah, and how everybody's kind of figuring it out as they go.
Exactly.
All right, so we've got expected loss, peril distribution, trigger type. What's the last piece of the cat bond quality puzzle?
Exposure basis.
Okay, break that down for me.
This is all about how the bond's payout is determined. What are we actually measuring to decide if a catastrophe has happened?
So, like, are we talking real, provable losses?
Yeah,
Or is it tied to something more abstract?
that's the key difference.
Okay.
So Beyond Returns explains that there are two main types of exposure bases,
Okay.
indemnity and index-based.
All right.
So indemnity-based bonds are tied directly to the actual losses.
Okay.
So let's say a hurricane damages a bunch of insured properties.
Right.
The sponsor, maybe an insurance company,
Yeah.
they assess the losses. And the cat bond payout is based on that assessment.
Makes sense. What about index-based?
Index-based bonds, they rely on a predefined index or metric. So like a hurricane bond might be linked to a wind speed index.
Okay.
If the wind speed at a certain location goes above a certain threshold,
Yeah.
the bond is triggered,
Okay.
regardless of the actual losses.
So there's less ambiguity with index-based?
Right.
It's more transparent,
Exactly.
potentially faster to settle?
Yeah, and Beyond Returns notes that index-based bonds tend to be more liquid
Okay.
and more attractively priced for investors.
Because of those advantages.
Exactly. They also avoid those potential disputes over loss assessments.
Right, because with indemnity, you can have arguments about how much was actually lost.
Exactly.
So you'd think everybody would be rushing towards index-based.
You would.
But Beyond Returns says something really surprising.
What's that?
Indemnity exposure is still the most popular choice in 2024.
Really?
Yeah, why is that?
It seems sponsors really value that direct linkage to their actual losses. They see it as a more precise way to hedge their risk.
So it's more tailored to their specific needs.
Exactly.
So there's this kind of push and pull happening.
There is.
Investors like the efficiency and the transparency of index-based, but sponsors are sticking with indemnity for its direct risk mitigation capabilities.
Right. So the cat bond market is constantly trying to find that balance.
Yeah, between what investors want and what sponsors need.
Exactly. But it does make you wonder if this preference for indemnity, will it limit the growth potential of the market?
That's a good question for another time.
It is.
So we've covered a lot of ground here.
We have.
We've got these 4 key indicators.
Yeah.
Expected loss, peril distribution, trigger type, exposure basis.
Yeah.
And it seems like they're all in flux.
They're
Influenced by investor demand, sponsor preferences, and this crazy risk landscape we're dealing with.
It's a constantly moving target.
It is, and understanding all of this is crucial for anybody
Absolutely.
looking to navigate the cat bond market
For sure.
in 2024 and beyond.
Definitely.
Well, on that note, let's dive into some of the specific events that shook up the cat bond market this year.
Sounds good. Let's do it. So we talked about all these quality trends.
Yeah.
But let's zoom in on one specific period this year
Okay.
that really shook things up.
Right.
Spring 2024,
Oh.
riding the wave, really captures the drama of what happened.
It really does. It was like this sudden storm
Yeah.
out of nowhere.
It came out of nowhere.
Cat bond yields just shot up,
They did.
seemingly overnight.
Especially those tied to U.S. hurricane risk.
Right. So what exactly caused that?
Well, there were a few factors.
Okay.
First, there was a lot of talk about a potentially hyperactive hurricane season.
I remember that. Yeah.
And remember how we talked about that concentration of risk?
Yeah, in Atlantic hurricanes.
Exactly. So any hint of a busy season makes investors nervous.
It makes it.
And yields go up.
Yeah, investors want to be compensated for that risk.
Right. They want a bigger premium.
So it's like everybody's holding their breath,
Yeah.
waiting to see what's going to happen,
Better.
bracing for impact.
And then on top of that,
Yeah.
one of the major hurricane risk models was updated.
Oh, right. Right around the same time.
Yeah, and it basically painted a much more concerning picture.
Mm.
These models have a huge impact.
On how investors see risk.
Exactly. So any big change to those models,
Can really move the market.
it's like everybody suddenly reevaluated the risk,
Yeah.
especially in those Gulf and Florida areas,
Especially there.
wondering if they were underpriced.
Right. Were they getting enough return for the risk?
Exactly.
And it wasn't just hurricane fears driving the surge.
Okay.
Riding the wave
Mm-hmm.
also mentions some portfolio rebalancing.
What does that mean?
So sometimes large investors,
Like who?
like pension funds, hedge funds,
Okay.
they decide to adjust their asset allocations. And that can create these ripples in the market.
So maybe some big players were pulling back from cat bonds,
That's definitely possible.
pushing prices down, yields up.
It's definitely one theory.
But what I find really interesting is how quickly things calmed down.
Yeah, Springing Ahead talks about that.
The surge was temporary.
It was. Spreads widened really fast, but then they settled back down just as quickly.
So it's like the market overreacted initially.
Yeah.
And then corrected itself as things became clear. It shows how efficient the market really is.
It's pretty remarkable.
It is, but it's a good reminder that cat bonds,
Yeah.
they can be volatile in the short term.
Even though they offer those diversification benefits.
And potentially high returns.
You got to be ready for those ups and downs.
Absolutely. It's not a smooth ride.
All right, so we talked about quality trends.
Yeah.
We talked about market dynamics. But now let's get to the bottom line.
Okay.
How did cat bonds actually perform in 2024?
Springing Ahead breaks down cat bond returns into 3 components.
Okay.
Price return, collateral return, and floating coupon return.
All right, so let's start with price return.
Okay.
What were we looking at there?
Price return just reflects changes in the market value of the bonds.
Okay.
So remember back in 2023, after Hurricane Ian, prices went way up.
Investors jumped in.
Exactly.
But 2024 was much more modest.
It was. Price returns came in around 2%.
So less dramatic.
Maybe real less volatility.
Things calmed down a bit.
The market found its footing.
And Springing Ahead attributes that to a compression of yields.
Right, on bonds issued in 2022 and 2023.
So as new bonds came out with higher yields, the prices of older bonds had to adjust.
Exactly, to stay competitive.
Makes sense. So price returns were decent, but not spectacular.
Right.
What about collateral return?
That was a key factor in 2023 as well.
It was, I remember.
Collateral return is the yield earned on the collateral backing the bonds.
Right.
Usually that collateral is invested in really safe stuff.
Like what?
Like money market funds.
Okay.
And thanks to rising interest rates, collateral returns stayed strong in 2024.
Okay.
Contributing about 5% to the overall return of the cat bond index.
So it's like a bonus yield.
Yeah.
Regardless of what happens with the cat bond itself.
It's a nice little cushion.
It is. It provides some stability and downside protection.
Which you don't always get with alternative investments.
Okay, so price return was decent. Collateral return was solid.
What about that third component?
Floating coupon return.
Yeah, that one.
That was the star of the show in 2024.
Really?
Remember how spreads widened?
Yeah, after Ian and during that spring surge.
Exactly.
So wider spreads mean higher coupon payments.
Right.
For investors.
And those higher coupons really boosted the floating coupon return.
Okay.
Especially for bonds issued in late 2022 and throughout 2023.
So the volatility of those previous years actually benefited investors who got in at the right time.
You got it. Springing Ahead shows that bonds issued in 2021, 2022, and 2023 contributed over 75% of the total return so far in 2024.
Wow.
Largely because of those higher coupon payments.
So even though price returns were more muted this year, the overall return was still pretty strong.
Exactly, because of those coupons.
It really shows how important timing is.
It does.
And understanding those market cycles.
Absolutely.
Okay, so we've got a good handle on the return picture.
Yeah.
But Vijay keeps talking about this idea of price adequacy. Right.
What is that exactly?
It's about getting enough bang for your buck. It's not just about the absolute return. It's about the return relative to the risk.
So are you being properly compensated?
Exactly.
For the possibility of a hurricane wiping out your investment?
That's the question.
So it's like a risk-adjusted return metric.
Exactly.
And Springing Ahead says cat bonds issued in 2023 and 2024 seem to be offering a better price per unit of risk than previous years.
Much better.
So investors are getting more yield for the same level of risk.
Or the same yield for less risk.
Either way, sounds good to me.
It's a win-win.
It suggests the market is pricing risk more accurately.
Right.
And investors are being rewarded appropriately.
For those potential downsides.
And even that spring surge we talked about.
Yeah.
Which seemed like a bad thing at the time.
It did.
Actually helped with price adequacy.
It did for bonds issued in the second quarter.
Because of those higher spreads?
Exactly. Investors who bought in then got even better pricing.
So short-term volatility can create opportunities.
It can, for those who are paying attention.
But the big question is, will this trend continue into 2025?
That's what we'll explore in the final part of our deep dive.
All right. Can't wait.
There are some reasons to be optimistic.
Okay.
But also some potential challenges.
Stay tuned, folks. So we've looked at cat bond quality trends. We talked about that crazy spring 2024 surge.
Right.
And we even crunched the numbers on returns.
We did all that.
But now I'm thinking bigger picture.
Okay.
What does all this mean for the future of cat bonds?
Yeah, where's this market headed?
That's the big question.
It is a big question.
And like VJ says in Beyond Returns,
Yeah.
there's no crystal ball.
Nope. No way to predict the future for sure.
But we can look at the trends.
We can look at what we know.
And try to extrapolate.
Right. Kind of like those hurricane forecast models.
I like that analogy.
Not perfect.
Right.
But they give us some scenarios to think about.
So let's put on our cat bond forecasting hats.
Okay. I'm ready.
We've got lower expected losses,
Uh-huh.
concentration of Atlantic hurricane risk,
Right.
aggregate triggers, making a comeback.
It's a lot.
It is. Where do we even begin?
Let's start with those lower expected losses.
Okay.
Seems like good news for investor.
On the surface, yeah.
More stability, less risk of losing your principal.
But it makes you wonder,
Yeah.
are cat bonds losing their edge?
Interesting question.
Like, they were designed to provide these high returns
Right.
in exchange for taking on significant risk.
That was the whole idea.
So if the risk keeps shrinking,
yeah.
will the returns still be there?
And will investors still be interested?
Exactly. They might find better returns elsewhere.
Right. With less complexity.
Why bother with cat bonds if you can get the same return somewhere simpler?
It's all about relative value.
So the cat bond market has to find that sweet spot. Enough risk to attract investors looking for those high returns.
Right. But not so much risk that it scares them away.
It's a balancing act for sure.
It is, and Beyond Returns points out another challenge.
Okay.
Those traditional pricing models,
Yeah.
they might not work as well.
As expected losses decline.
Exactly. We might need new ways to assess risk.
The models need to evolve.
Along with the bonds themselves.
Okay, that makes sense.
It does.
But what about this hurricane risk concentration?
Yeah, that's another big one.
Should we be worried?
It's definitely worth watching.
Like we said,
Any major hurricane activity
in the Atlantic,
could trigger a lot of payouts.
across the whole market,
It's systemic risk.
vulnerable to one type of event.
Exactly.
And Beyond Returns really emphasizes that.
It does.
Talking about diversification.
Not just across asset classes.
But within the cat bond space itself.
Don't put all your eggs in one basket.
Right, diversify across perils.
Even trigger types.
Spread the risk around. Okay, and speaking of trigger types,
Yeah.
those aggregate triggers coming back.
That was a surprise.
It was. Any more thoughts on what's driving that?
Still a bit of a mystery. Beyond Returns throws out some ideas.
Like what?
Maybe investors are getting more comfortable with aggregate risk.
Okay.
Or maybe sponsors want more aggregate coverage.
To protect themselves from more things.
Exactly.
But maybe it's just the market maturing.
That's possible too.
Investors getting more sophisticated.
Right, better models.
Sponsors getting more creative.
That's how they structure the bonds.
It's an evolution, not a revolution.
I like that.
And it kind of ties into this bigger theme from Beyond Returns.
Okay, what's that?
The cat bond market is becoming more nuanced.
It is. It's getting more complex.
It's not just black and white anymore.
Not just hurricane hits, bond pays out.
Right. It's about understanding the subtleties.
The nuances of risk.
How everything interacts.
The needs of sponsors and investors.
It's a lot to keep track of.
It is.
And that brings us to that last piece.
Indemnity exposure.
Sponsors just love it.
They do.
Even with all the advantages of index-based,
It's that direct connection to their actual losses.
they don't want to let go.
It's understandable.
But it does make you wonder.
About the future growth of the market.
Right. Index-based bonds could bring in more investors.
Yeah. Those who might be hesitant about indemnity.
So it's this tension between standardization and customization.
Sponsors want tailored bonds.
Investors want simplicity.
Makes sense.
So what's the takeaway?
I think Vijay nails it in Beyond Returns.
Okay, what does he say?
The cat bond market is fascinating.
It is.
It's unique. It's got this great risk-reward profile, diversification, potential for high returns.
Yeah, that's like good stuff.
But it's not easy.
It's not for the casual investor.
It takes work. It takes learning. You have to stay informed.
You got to be on top of those trends.
Absolutely.
So keep learning, keep asking questions,
Yeah.
and don't be afraid to challenge those assumptions.
That's good advice.
The cat bond market is constantly changing.
It is. It's dynamic.
And those who adapt,
And stay ahead of the curve.
they'll be the ones who succeed.
Couldn't have said it better myself.
Well, folks, that's our deep dive into the world of cat bonds.
It's been a fascinating journey.
It has. Lots to think about.
And lots to keep an eye on in the coming months.
Absolutely. Thanks for joining us. We'll see you next time.
Thanks, everyone.